The first rich decision in your life was probably made before you earned a single rupee. Not by you, by a number you've likely never seen. Because today, wealth doesn't start with talent, it starts with access. Right now, two people walk into the same bank, same age, same education, same business idea. One walks out with cheap money, the other walks out with nothing. That difference compounds for decades. And this is why credit quietly decides who gets rich. Here's the part we're rarely told. Money is not created when you work. Money is created when a bank approves a loan. Every mortgage, every business loan, every credit line, that is new money entering the economy. But it doesn't enter equally. Banks don't lend to people who need money. They lend to people who already have it. Assets first, income next, opportunity last. If you already own property, you borrow cheaply to buy more property. If you own shares, you borrow to buy more shares. Your wealth becomes collateral to multiply itself. Meanwhile, someone without assets borrows at higher rates or not at all. Same economy, different doors. Now the uncomfortable math. If you can borrow at 4% and buy an asset growing at 8%, the system pays you for existing. If you borrow at 18% to survive, the system charges you for being poor. Over time, the gap doesn't grow linearly. It explodes. Publicly, we celebrate entrepreneurship. We praise hard work. We tell stories about hustle. Quietly, the biggest fortunes are built with leverage, not effort, access. Zoom out. Entire countries now depend on this mechanism. Central banks lower rates, asset owners get richer, debt grows, inequality widens, and the system calls this stability. So here's the question. In a world where money is created through credit and credit flows toward existing wealth, is inequality an accident or is it the design? Because if access decides opportunity, then the real currency isn't money, it's permission.